Episode 182 of Futures Radio Show, sponsored by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world effectively manage risk. For access to free educational tools and resources for the active individual trader, please visit activetrader.cmegroup.com.
Every day, traders and investors dive in to tackle the ever-changing markets to find opportunity. Futures Radio Show is your number one source for answers to the questions that all market participants want to ask. Veteran futures trader Anthony Crudele sits down with the most influential leaders and top traders in the industry. Now, here's your host, Anthony Crudele.
Hey everyone, before we get started today, I want to thank our sponsors. CME Group, Trading Technologies, RJO Futures, and Top Step Trader. Now today I spoke with Dale Pinkert, host of FACE, Forex, Analytix Community Experience. I had an enjoyable conversation with Dale. We began our chat by talking about Dale's backstory and why he is a big proponent of social trading. We talked about Dale's methodology when it comes to the RSI, the real simple implicator. We spoke about trading using fundamentals and trading data points such as the monthly unemployment number. Finally, Dale discusses drive formations and sings a song about trading using leverage. As usual, thank you all for listening and please enjoy this episode. Dale, welcome to the show.
Anthony, thank you so much for the invitation. I've been a fan of yours, watching you from afar, and it's great to be on the other side of the mic.
Thanks, Dale. I really appreciate that, and it's a pleasure to have you on the show today, giving you a chance to get on the opposite side of the mic. You do great work with FACE, always giving traders great content on your show, so I'm excited to speak with you today. A lot of topics to go over, but before we begin, I'm very interested in your backstory. I know that you're the host of FACE. I also know that you're a former IOM member of CME, so I'm very curious, how did it all begin, Dale? How did you get your start in the trading industry?
Okay, what an interesting and fateful day that was, Anthony. In fact, I went to NIU, Northern Illinois University, and I had a major in journalism, minor in speech, and it was in 1975 when I graduated. We were in a kind of a severe recession. So what was really available to me was nothing related to journalism at that time. And I had a friend, I grew up in the northern suburbs in Skokie, Illinois, and there were a lot of guys whose fathers were traders at the CME or they were working at the CME. So a friend of mine invited me to come down, and he was going to get me on the floor as a guest to check it out. So I started off, took the Swift to the L and thought I had gotten off at the CME, and I'm wandering around this big building and I'm asking people, where's the trading floor? And they're all giving me unusual looks like, oh, this kid is lost. And finally someone said, there is no trading floor here. You're at the merchandise mart. So my first attempt to get to the CME, I ended up at the merchandise mart where wholesalers have showrooms and, they're wholesaling out their products, etc. But I got back on the L and found the Merc, and that was the old Merc, Anthony. You're a lot younger than me. I don't know if you remember the old Merc on 222 South Riverside Avenue. It was above Union Station. I think they turned it into the mid-amp floor later on, but in the mid-'70s, that was the hub along with the CBOT. And I remember getting there and going up to the gallery, and some of the more active markets at that time were the meats. And I'm looking, and all of a sudden I start to hear big roars coming out of the pit that said pork bellies. And it was audible. And at that time, I didn't know they were probably making new highs on the day, new lows on the day. But in those days, when they elected stops above pivot points that people would call them nowadays, or some type of important high or low where everyone had their stops, you would hear an audible roar as those stops were elected. So my friend signed me on the floor, signed me on, And I went around from desk to desk and said, I really don't care about what the salary is. I just really want to learn. I'm interested in this. It was an amazing atmosphere. It was always my dream to, make a lot of money. And I saw what kind of cars were parked out the exchange, and chauffeurs and guys in red jackets and the action. So Dean Witter took me on as a runner, and that was in 1975. And in fact, although I'm involved in retail FX, I was on the floor, Anthony, when the IMM just began, and they were trading currency futures on chalkboards, because I remember running orders out to, the Swiss. There was no euro then. There was a D-mark, and brokers taking the orders and writing the bids and offers down on a chalkboard. So, I've been there, been around, and have seen every cycle since futures initially, before retail FX, the cash market became popular in the late 90s. I've seen quite a few cycles in currency markets. I remember the peso devaluation and guys losing their seats over things like that. So that was my beginning, and worked my way all the way up to being a phone clerk, from being a runner to becoming a phone clerk, and then sticking around for a few hours after the close to handle what was called out trades, of trades that didn't match up. And you, having been on the floor, I'm sure you know what an out trade is.
Yep.
And I took a course at the CME in technical analysis. And the guy who was the instructor, his name's Alan Rohrbeck. He still writes the Rohr Report. He just bought a membership to trade lumber on the floor. And at that time, brokerage offices, I was with and registered with a company called Madoff and Sons. They were very well known for the belly and hog market. So he'd be upstairs trading lumber. He'd be downstairs on the floor trading lumber, and I handled his clientele base upstairs in Madoff and Sons. And from then on, the long and winding road continued.
Wow. Yeah. I mean, just bringing back all these memories. Old CME I was not at. I think the new CME came into effect in the early 80s, 83 if I'm not mistaken. And I'm just thinking back to some of the things you said, pork bellies. That's not even a contract anymore.
Yeah.
I mean, hard to believe that they got rid of that. I don't know the reasons. I never remember reading about it, but that was one of the busiest pits back then, pork bellies.
Yeah, and I remember when that was the meats were fairly new. Before that, I think the big contract there were eggs that also went defunct with some type of, scandals in the egg market. I guess it became more of an omelet than a futures contract. So anyway, yeah, so the meats were really the dominating force on the CME floor. And of course, it's pre-S&Ps as well.
Yeah, I started actually in the meets as well. You were a runner for Dean Witter. I was a runner for Lynn Waldock. And
my gosh.
Only a few firms.
Lynn.
Yep.
I even remember the color of the coats. You guys wore blue coats.
Yep. And remember the out trade clerks, you talked about that, and they wore the powder blue coats.
Yeah, that was part of the caste system. But, all of us runners and clerks were all desiring to have a red jacket. Weren't you?
Oh, absolutely.
I don't know how long it took you, but it took me another 10, 15 years to finally get back there. I moved out west. I lived in California and Arizona, and was finally able to put it together and come back and trade for a while on the floor. Found actually I really didn't enjoy trading on the floor. When you learn to trade off the floor, you're not used to the noise. I didn't like out trade risk. And when I was there, I would just hand off my orders, so I didn't have that out trade risk to someone and pay a few bucks more for the trade to be cleared, and then go upstairs so I had more of an overview than just being micro with every bid and offer in one pit.
Yeah, it took me about 3 years to get my membership. I started on the floor when I was just over 18 and then became a member when I was 21. So I was pretty lucky in that manner. But I hear you on the out trades, especially a guy like me who was standing in the middle of the pit. There were so many people there. I couldn't tell if someone was trading with me or not. It's not really the reason why I lost money when I was in the pit, but ultimately I ended up going to the screens very quickly as well.
So yeah, a lot of people lost their memberships over out trades and human error. So maybe it's great that we have the internet now, but you certainly cannot replace the fraternity and the camaraderie and the intelligence gathering that was possible rubbing elbows with traders on the floor. It really was a unique period in trading history that, maybe I'm like the modern day Jesse Livermore reminiscing about the good old days of open outcry.
Well, let's talk a little bit about that. You mentioned intelligence gatherings, and I know that you are a big proponent of social trading. Why is that? Why are you such a big proponent of social trading and getting people together for these intelligence gatherings?
So, I would say as a young guy, and I don't know how you were, but, before you're humbled earlier in your career, you had a pretty strong ego. And I would say that for the most part, I would follow or listen or read other people's work more with an eye of that they might be a good contrarian indicator, or people were mainly, because most failed, good to fade. And later on, and I really delved into it at FX Street. They started a project I co-created called LAR, the Log Analysis Room. And the thesis was that we would attract great traders that would want to share their work, and that we would develop a community to support people. There are a lot of Wild West chat rooms where there are people, I have a few rules. You don't root for anyone else's failures to rationalize your own, and respect the guests that I bring in, that I interview, because they're giving their time, even though they might pick up some business being there. But it's not a theory, because for years I did it, attracted great traders that had very good hit rates. And I could walk into a session, as I still do. I don't see things every day. I miss trades every day, but we only have two eyes. And after a while, when you see through screenshots, links that people provide, what their work is saying, the different types of methodologies that are used, that you could see things that with your own two eyes, before you got into that community setting, you wouldn't have even paid attention to. There's value in collaborating with people, especially, I say to people, Anthony, surround yourself with traders better than you. And that way you will rise to their level and you're going to learn. Also, in a community setting, it's a lonely business, especially if you're, doing it. I don't care if you have an ocean view and you're doing it in your room. A lot of people have giving natures. And really, when you think about it, what good is anything until it is shared with another? So there are a lot of traders that like to pay it forward. Similarly to like what Richard Dennis did, and there are many people that want to help people avoid the landmines that they have activated, and help them along the way, because they know they have empathy for people that are just starting off and know how tough of a business it is. In fact, after I became a Series 3 broker, a veteran broker pulled me aside, Anthony, and said, "Kid, this is a tough way to make an easy buck." And he was exactly correct. So I'm a big believer in the community setup. You do need a good moderator or facilitator, because the atmosphere in the room is very important to keep it positive. You don't want any people in there that are trying to be disruptive, destructive. You could ban or knock off people in a room. And I really think the moderator, the facilitator, sets the tone for the room. And it's also something that I really enjoy. You do, people have made friends. People have gotten married. There's an aspect to a community that a lot of people don't even have in their own neighborhoods anymore. I remember where I grew up, or a place I lived in California where I knew everyone on my street. Well, a lot of people don't even know their neighbors nowadays in this setting. So I do think that a supportive and accountable environment surrounded by traders that have a higher level of competency, hit rates, money management, methodology is a great place for beginning and advanced traders to be. Because as an advanced trader, if you're not sharing your work, you're not crystallizing your views. I have much more conviction after I talk about something or show something than maybe it's NLP than if I just think about it in my thoughts. It's kind of like writing something down. And you only really want to show your best stuff. So I think it even makes successful traders more successful being in a good community.
I agree on a lot of what you said there, Dale. Look, I started in the pit just like you did, and I believe that I learned how to trade by watching what other successful traders were doing. Especially at the beginning of my career when I was struggling so much, it was so important for me to see how other people were making money to give me confidence that I could actually make money. Now, that being said, something else in my experience I've learned that I think is very important for a lot of traders out there learning from other traders. Number one, I don't believe that there are two traders alike. And if you are learning from someone a way to execute a strategy, there has to be a way for you to be able to execute that based upon your personality. People can teach you certain things, but when it comes down to execution, I think it has to be, it's a very personable aspect of it. You cannot mimic what someone else is doing. And that leads me to my second point, that if someone is teaching you something that is exactly that needs to be executed exactly the way that they say, this is where I step in and say, well, if that's the case, why don't you just automate it? Why even teach me that? Let me just use the automation. That doesn't make sense to me, but people may disagree with that thinking. And I just want everyone to understand that there is no right and wrong way to do this. I don't think that anyone could say that there is a right and wrong way to trade. I think it all depends on the person and the way that we look at the market, the way that we view the market. So just wanted to add my 2 cents in there for that. I want to move on a little bit and talk about your RSI, your real simple implicator. Of course, when you mentioned RSI, I was thinking relative strength index, but then you said to me, no, I'm calling it the real simple implicator, and you have a specific methodology that you use when looking at the markets with the RSI. So, Dale, I'm interested. I'm curious. Talk to us about how that all works.
Okay, so most people use RSI mainly for saying when a market's overbought, oversold. I've seen a lot of recent tweets on Twitter showing the S&P weekly in uncharted waters at 89%. Well, okay, what's that tell you? Does it tell you that it's too high and it has to come down? What I've learned over the years is this is a game of probabilities. And if you go back and you back test and you look at a market, no matter the time frame, that I use the 14-day RSI, can't teach old dog new tricks, but if you see prices making new highs and momentum is confirming that high, meaning making a new high, not a lower high in momentum, that's rarely the top. It's a top, it could be a top, but what makes it actionable is if you know that the probabilities of a confirmed high is that that high isn't going to stand, then you know as a trader, you should be using your other tools, maybe fibs, maybe moving averages, maybe formations, looking for a continuation formation to buy the next pullback because that high is going to give way. And then you'll see whether or not that high confirms or doesn't. And when the RSI begins to not confirm those highs, then it's implying something else. It's implying that it's late stage, that you may want to be when in an uptrend and the RSI is confirming the uptrend, you may want to be lightening up on longs. And if it does it a couple of times successively, it has even more of an implication that the market is not only losing momentum, but may be subject to a reversal. So that's the two ways that I teach RSI. So there's something to be taken away from when momentum confirms a move, and there's something to be taken away when momentum begins to diverge and not confirm a move.
Okay, can you walk us through a trade, please? Tell us how you would get into a trade. Tell us what would determine the stop if you use a stop. And then what would be the targets for profit?
Okay, well, let's just talk about confirmed high. So say you had a $100 move in gold to the upside, and at that $100 mark, the RSI was confirming it was at 80, while gold was making a $100 advance. It wasn't diverging yet.
Real quick, what time frame on the chart are you using?
Okay, let's call it a daily, and
Okay.
it works on all time frames. So,
Okay.
first of all, I'd be looking for. I know that I shouldn't be short. That's number one, because I know that there could be a correction, but I want to be on board on that correction. So I might use fib tools um, for that, moving averages for that. Look for continuation formations, flags, pennants, and wait for those pullbacks to develop. Maybe even, as we talked before the show, scale into a trade at say 50%, 61.8 and maybe 78.6, wrong under the low. But one thing I want to talk about when it comes to stops, that when I talked earlier in the show about the audible roars you heard on the floor, you don't hear them, but there are still stop hunts, Anthony. The algos, the black boxes, they do it. So people say, Dale, how do you know where everyone's stops are? I say, well, why don't you just look at a chart, pretend you're long, where would you put your stop? And most people look at the previous swing low and they say there. I said, well, that's where everyone else's are too. So what I usually wait for those kind of lows to be taken out or those types of highs to be taken out. And if there's no follow through, that sets up a trade for me. So I advise people do not put your stops directly under a swing low where everyone else's is, because you could go to a chart, any time frame, and see multiple examples of a market taking out a swing high in a different time frame by maybe 10 pips in currency, maybe $2-3 in gold, and then people that are have their stops elected look at the market and it's underneath where their stop was filled. So be aware of stop hunts. Also, I look for being positioned into where I think there could be a stop hunt and doing what they do on the floor. If I think that I have a confirmed high and perhaps we get a little double top, and it doesn't work all the time, because there's a recent example. I thought the euro was going to take out its high 120.80 before we had this pullback, because I knew there was at least one buy stop above 120.80. It didn't happen. But normally you're going to have hope build up and stops build up. And if I know where the stops are, and I believe that the markets are a tough taskmaster that are going to shake out as many participants as possible before the move they're looking for manifests, then most likely without them, I want to take advantage of shakeout moves. So when I have confirmed highs or lows, I know stops are building during those corrections, and I'm looking for those highs to be taken out. And I use different fib levels for entering. Specifically, if I looked for a trade right now, I'm looking at TZA. Right now for myself, I haven't positioned myself here, but I'm getting the kind of divergences. That's, I believe, the Russell 3 times bearish ETF. I'm getting all kinds of divergences that are starting to build here. I'm approaching some S&P targets of 2764, which actually came from a guy who called that number in April, one of my guests, and that again is part of my intelligence gathering. A lot of my thoughts, a lot of my trades is a combination of listening and paying attention to people whose work I respect, In fact, I could take social trading to the next level and have a bunch of experts, like I currently facilitate a, a show, a room with Forex Analytix, and the social trading has been taken to not just attendees sharing their views and sharing ideas with a moderator, but experts from different disciplines at times pointing towards the same outcome. We have a guy who specializes in Elliott, a gal who specializes in harmonic work. We have conventional technical and candlesticks. And there are many times, and these are guys I all interviewed before I joined them at FX3, so I respect their work. So that's another level of intelligence gathering, not from the community, but from a group of contemporaries that you're working with.
Do you use any fundamentals?
Yeah, I believe that you have to pay attention to fundamentals. I'm also a big believer in if you buy headlines today, you sell newspapers tomorrow. So, I'm not a big news trader. I really teach people to react to reactions. For example, on big red days like the NFP or a Fed meeting, I'll tend to be flat or very lightly positioned instead of a binary event being red or black like a roulette bet. I would rather be prepared, like on the last NFP, I was preparing people to sell, to buy into dollar weakness, which is exactly what happened last Friday. So I'm a big believer in reacting to the reaction rather than predicting a reaction. I had a guy come up to me after the NFP, said, Dale, I was long the euro, and we came out, the NFP was a weak number, and the euro rallied 120 pips. And I said, good guess.
Yeah, I mean, as a day trader, it makes absolutely no sense to me, at least, to go into any one of these numbers with any sort of position on, because look at how the markets move even before the numbers hit the tape. Sometimes they'll move dramatically in both directions, and then the number comes out, and then it moves in a direction that even if you were in a position either way prior to it, it got you out. So, yeah, I think it's a gamble, and I've learned my lesson way too many times going into these numbers with positions. I prefer waiting to see if I get a price opportunity from the data that comes out that fits within my strategy.
The things I teach, Anthony, I've either seen or I've lived through myself. I remember when money supply numbers were the big number every Friday. There'd be, money supply numbers, and the Fed would act on those numbers sometimes over the weekend. And I remember scaling into short euro dollar positions, not the currency, but the 90-day paper, and getting home and then turning on CNBC. At that time, you went into an office to work, and hearing Ron and Sana say, well, how much higher are the bonds going to be on Monday now that the Fed has cut the discount rate? So, I've blown out my account doing that. So, it's important to share what you've learned to help people avoid doing that. And, that's one of my major rules is, not to be a gambler, especially on a red event like that. So I've lived it.
You also talk a lot about drive formations. You mentioned to me that you learned about this from J.R. Hill in the 70s. Talk to us a little bit about that.
Okay, well, that does tie in a bit with the RSI. They mainly happen in wedge patterns, Anthony, where you'll have some type of three moves to a high, each high being successively higher, moderately higher. And the first high is usually a confirmed high on a wedge, and then you get the pullback, and then you get another drive to the high that normally does not confirm, and that's the first non-confirmation. And then you get another pullback, and then the next rally, you even have a lower RSI reading, and that's a three drive to a top formation. They happen the other way on three drives to a bottom. In fact, the first three drive example was a three drive to a bottom formation. They're normally in a wedge, and a wedge is where you have lines that eventually are coming together to intersect, and there's compression being built up in that wedge. And something that I teach is that people go, okay, Dale, well, it's breaking down out of a rising wedge, or it's breaking out of a falling wedge. What should I be looking for? 38%, 50%? What type of retrace move should I be looking for? And what's beautiful about wedges is you can look for 100%. That those wedges, which are reversal formations that I learned all the way back using Edwards and McGee, technical analysis of stock trends, so they're big potential moves. And also, if you think about the number 3, and you talked about how it resonates with your work, but on all different kinds of levels, the number 3 means completion. The third time's a charm. 3 strikes, you're out. Hockey is 3 periods, and everyone on the ice wants a hat trick. The Earth is the third planet from the sun. So it's a number of completion. Even on the spiritual level, people worship the Trinity. So the number 3 is a number of completion. It's not the only one. And there are times when I'm waiting for a third drive and it doesn't appear. Sometimes it only takes 2, just one divergence for a turn to happen. But I'm happy to miss moves and maintain my discipline if that happens. That's something else that I teach people. Why don't you just accept and take the pressure off yourself that you're going to miss trades every day, and that's okay, because there's always another bus around the corner.
I want to comment on the rule of 3. A lot of those things you just mentioned, I had no idea, but yet when I was building my strategy and learning how to execute, the rule of 3 continued to surface. And one example that I've used many a times, either on this show or in Periscopes or just talking with other traders, is in my execution, I felt that I really learned how to execute when I was able to do a third at a time and execute in a range versus being held by one price with a one lot. When I first started trading, I was trading one contract at a time, and I felt I was too price sensitive. And once I started to learn how to trade in a range of execution, know when to be big, know when to be small, and know when not to trade, and also knowing when to trade closer to my stop, or know when to trade further from my stop, and adjust my contract size based upon how big my risk was, I felt a lot more confident, and I got a lot better at trading. So that was one thing that helped me tremendously. So I just wanted to mention that. Now the next thing I want to talk about, since we're already on the topic of execution, is leverage. In the futures industry, we get a lot of leverage. And I think a lot of new traders and even some advanced traders really struggle with this. I know that in my career, I've made many mistakes by trading too big, because you get so much more leverage when you're trading futures. So it's so easy to trade much bigger than you can afford to. So Dale, talk to us a little bit about that. What do you tell your students, and what have you learned about trading using leverage?
Well, I believe, especially for new traders, I'm not a big believer in demos because people don't take them seriously. So in the FX world, I tell people to trade micros, which is a real reduced leverage, but they still have money on the line, so they could get the feel for what it's like to have actual risk. In the old days, we would paper trade, right? And, what was the worst thing that could happen to you when you paper traded? You get a paper cut. So, I'm a big believer in people using very low leverage, at least for the first year, year and a half. And the biggest problem is that people hear about all these outrageous types of returns on the internet, Anthony. They hear, 500%, 1,000%, when in reality, hedge fund managers do cartwheels doing 25% a year. So, first of all, I think people need to reduce their expectations. People ask me all the time, Dale, can I trade for a living with a $10,000 account? I don't know if you tried it, Anthony, but I say, yeah, if you want to live beneath an underpass. So, I think that people have to reduce their expectations and be happy compounding 25, 30% a year off their money in the market instead of trying to double their money every 6 months. And when you go to the baseball analogy, your home run hitters are also your biggest strikeout kings. So if you're going to swing for the fences, this is a one mistake business. And if you make that mistake, you're out of the game. So I tell people to trade small. You might have $25,000 in your account, so pretend you have two, okay, and keep the other 20 in T-bills and collect interest, and down the line use it. But I am a big believer in reduced leverage. I know some people that trade without leverage and make very good money without leverage, because especially in the stock market, there's been a 30% move just in the averages, let alone some stocks have doubled and tripled since the election last year. So leverage wasn't even necessary, and it's probably the people that levered up that when there were pullbacks got shaken out. So I'm not a big believer in big leverage. In the FX industry for a while before Dodd-Frank, there was 200, 500 to 1 leverage, ridiculous leverage capabilities for people in FX. So I actually wrote a song, Anthony, on using less leverage. Use less leverage when you trade the markets. Use wider stops so you don't get picked off. If you don't use less leverage, you might lose your head and your account will be dead. Use less leverage.
Well, there's a first for everything, and it's the first time someone sung on my show. So
that's great serenading you, Anthony.
That was classic. Well, Dale, we're gonna leave it on that note, and we're gonna get into rapid fire in just a moment here. But I gotta tell you, that was really a great convo. But like I said, we're not done yet. I have rapid fire questions if you're ready for those.
Let's go.
All right, everyone. Our rapid fire segment is brought to you by Trading Technologies. Access the global markets from virtually anywhere with TT. They are the world's fastest commercially available futures trading platform. And coming March 1st, trade cryptocurrency spot and derivative markets side by side for the first time. For more information, visit tradingtechnologies.com. Dale, first question. What trader has influenced your life the most and why?
J.R. Hill, because of the 3-drive technique that I made my own and refined it with RSI.
How has your trading evolved over the years?
I've learned to be more patient. I'm okay with missing trades because I know there's always another trade around the corner.
What is the number one resource you spend your time on?
I spend my time collaborating with great traders in Forex Analytix and going over their research and looking at my screen first and then going to see other people's work to give me more conviction or less.
What is your favorite book about trading or the markets?
Reminiscence of Stock Operator, Jesse Livermore.
What's your favorite movie or TV show about trading or the markets?
Would have to be Wall Street with Gordon Gekko on the beach in the Hamptons, waking up Bud Fox saying he already made a ton of money in Hong Kong gold.
What's the best piece of advice that you've received about trading or the markets?
I've received it from Jack Schwager, author of Market Wizards. Find a trading style that fits your personality.
Now, if you can give a piece of advice to the new people interested in getting involved in trading, what would it be?
There's no law that you have to trade. It's a choice. And there's no secret to trading. It's hard work and persistence.
Last question, Dale. If you weren't involved with markets, you'd be doing what?
I'd be out there looking for a job in broadcast journalism. I love the microphones and cameras.
Dale, where can people find you on Twitter, and give us a website to check out?
Okay, at Forex Stop Hunter and www.Forex Analytics, that's ANALYTIX.com.
Dale, this was great. It was really good to talk with you about the old days. I had a lot of fun. It was very informative. I know that a lot of traders are going to enjoy this episode, so thank you so much for coming on Futures Radio Show.
Good hunting in 2018, my trading warrior brother, Anthony Crudele.
Thanks, Dale. Cheers.
All right, buddy.
Thank you for listening to Futures Radio Show. If you have any questions or comments for myself or my guests, please visit futuresradioshow.com and sign up to be a premium member for free. If you enjoyed the show, don't forget to leave us a review on iTunes.